Setting up for retirement with complete financial freedom is the goal, right? Living life on your own terms, having the money to pay for all of life's expenses, even whilst being in the middle of an energy crisis and record high inflation rates. You want to be in a position to stop trading your time at a job for a payslip at the end of the month.
You guys are getting paid?
Well, if that's the goal you have, well, today I'm going to share with you guys how investing can ensure that you get there. It really doesn't matter whether you're just in your 20s starting out or whether you're a little bit of a late starter in your 40s and 50s. So let's talk about how you can actually start investing, what you should be investing into, along with how you can actually accelerate the total value of your investment portfolio regardless of how old or young you are. So first and foremost, let's talk about investing principles. Because in order to be successful in the investing realm, there are a certain set of principles that you're certainly going to want to understand. These are the principles that I've picked up on my own investing journey over the past 5 years, and they've given me a great sense of clarity on what I'm actually working towards with my finances. So let's talk about the first one, which is the time value of money. Now, it's a fairly simple concept that means a sum of money is worth more now than the same sum of money will be at a future date. And understanding this very concept is the reason why anybody and everybody should be simply investing for their future. Because £100 today with the current rates of inflation of 10% per year will only actually be able to buy you £90 worth of goods 1 year from now. Because inflation is the silent erosion of the value of your money over time. So in order to combat that, we need to grow our real wealth and not just our nominal wealth. And in order to do that, well, we need to be investing into inflationary beating assets. And I'll show you exactly what those are a little bit later on in the video. Now, the second principle is something called the compound effect. Albert Einstein once said that compound interest is the eighth wonder of the world. He who understands it, earns it, and he who doesn't, pays it. And well, let me demonstrate the absolute importance of understanding it in order to ensure that you guys can earn it. Now, let's say I was feeling generous and I offered you guys
$1 million.
Or you had the option to take 1 penny today, but I would double that penny every day for 30 days. Which option would you take? Let me know down in the comment section below. Because look, the £1 million in cash certainly feels quite appealing. You would literally become an instant millionaire overnight. But in actual fact, if you took the 1 penny instead, which doubled every day for 30 days, you would end up with £5,368,709. So you'd be over 5 times richer from letting the power of compounding do the work for you versus not. Visually, this is why Warren Buffett's net worth looks like this, where he's actually accumulated over 99% of his wealth after the age of 50. So if you are a little bit later on in life watching this video, don't worry because the numbers can still work for you too. However, if you are a little younger, perhaps in your 20s or 30s, well, you've all got a hell of a lot of upside to come. So they're the two principles that I wanted to share with you guys. But I've also had to make 2 key assumptions in order to kind of formulate the rest of this video in, I guess you could say, the most accurate way. The first assumption being the younger you are, the more risk that you can be prepared to take. Why, you may ask? Well, there are probably 2 reasons why you could actually look to take more risk at a slightly younger age. The first and probably the most obvious reason is, let's say that you're investing into slightly higher risk assets like equities as an example. But let's say the stock market then goes on to crash 20, 30, perhaps even 40%, well, you'd still have plenty of time ahead of you in order for your investment portfolio to recover in value. Whereas if you're a little bit later on in life, you don't really want to be fully exposed to all of those higher risk assets, because if the stock market crashes 40% the day before you retire, well, you're going to find yourself in a little bit of a sticky situation. Secondly, let's say that you've got the appetite to invest in, I guess you could say, some more speculative assets. Let's say you chuck £1,000 into Bitcoin as an example, and the price of Bitcoin goes up tenfold, let's say, well, you would have made £10,000. But then on the flip side, if the price of Bitcoin goes to zero,
you heard it here first, Bitcoin is going to zero.
Well, you've only actually lost £1,000, and you've still got plenty of time ahead of you in order to recuperate those losses. However, on the flip side, from taking that extra risk, you also get the potential for extra upside too.
I'm talking about this.
And it all comes down to that mindset of risk versus reward. And I guess the younger you are, the more risk you can potentially be prepared to take in order to capitalize from those higher levels of reward. And because of that, the younger you are, the more flexible that you can be with your overall approach to investing. But if I were to summarize and plot risk versus age on a graph, this is what it would look like. Now, the second assumption I'm also going to make is that the younger you are, the easier it will be to actually generate wealth over the course of your investing lifetime. And this directly links back to the compounding principle. Now, I'm not going to dress this up for you guys if you're in, let's say, your 50s and you've got £0 and 0 pence invested unless you've got a bloody big salary or you've got a huge amount of inheritance coming your way, you'll find it significantly harder to generate a huge amount of wealth than perhaps the 25-year-old that's simply just investing £500 a month into his or her investment portfolio absolutely passively. Let me demonstrate this to you guys by sharing the numbers. So let's assume that we all want to retire by 60 years of age. And let's say you've got two individuals, a 25-year-old called Mitch and a 50-year-old called John. Now let's say Mitch invests £500 per month at an average rate of return of 8% per year, which is roughly the long-term average of the stock market. And let's say he invests for 35 years right the way up to retirement, but continues to increase those monthly additions in line with an inflation rate of 2% per year. At retirement age, Mitch would have a rather nice investment sum of £1,420,382. Now, I know the time value of money principle and essentially inflation will eat into the total value of that £1.4 million 35 years from now, and that £1.4 million 35 years from now would not be worth what £1.4 million would be worth today. But nonetheless, it's still a pretty decent sum of money, and it's certainly a hell of a lot more than what the average pension pot in the UK is right now, which is only 61,987 quid. But back to the point, let's talk about John's situation, who is only 10 years from retirement. But because John's a little bit further on in his career than Mitch is, he's certainly got a little bit more disposable cash in order to invest into his investment portfolio. However, despite John having a higher salary, in order for him to get to that £1.4 million investment portfolio within the space of 10 years, then he's going to need a hell of a lot more than £500 a month to invest. In actual fact, he's going to need the equivalent to £7,100 per month in order to get that same £1.4 million investment portfolio value that Mitch had. So hopefully that demonstrates that the earlier on in life that you are, that you can get started investing, the better the chances that you have in order to generate a huge amount of wealth over time and go on to achieve your financial goals. So with that in mind, where exactly should you invest? Well, I've used Vanguard UK as my trusted source for investment portfolio management. And in essence, Vanguard says that the older that you get, the more conservative that you should be with the investments you have. Which makes sense because nobody wants a 30% fluctuation in the value of their investment portfolio the year before they're due to retire. So how exactly do you achieve this within your investment portfolio? Well, Vanguard has presented this glide path for investment portfolio management, which essentially shows what your portfolio allocation should look like dependent on your age. So pretty much between the ages of 20 and 45, you should have 80% of the value of your portfolio held in a mixture of 20% in UK equities and 60% in global equities, and the remaining 20% should be held in global bonds. So in a nutshell, an 80-20 stock bond split investment portfolio. Now you might be thinking, well, between the ages of 20 and 45, what investment returns could I potentially expect from this type of asset allocation? Well, thankfully, Vanguard also has something called a life strategy fund, which has this exact asset allocation built in within it, so we can actually look to benchmark against the returns of this fund. So since this fund's inception, all the way back in 2011, it has actually achieved a cumulative return of 107.91%, which is the equivalent to a compounded annual growth rate of 7.59%. And it's probably also worthwhile me mentioning that only one of the 10 years of total investment performance have actually provided a negative return on investment. So in other words, you have a 90% chance that your investment portfolio is going to go up in value every single year. But when you surpass the age of 45, this is the time in life that you might want to consider potentially de-risking your overall investment portfolio, perhaps being a little bit more conservative with your investments in order to preserve the value of them. And in short, the way to do this is to gradually reduce your exposure to stocks and essentially increase your exposure to bonds because they're the less volatile asset class. So going back to the glide path, at the age of 50, your allocation should be around 75-25. At age 55, it should be 70-30. At age 60, it should be 60-40, and at 65, it should be 55-45. Now let me give you guys a little bit of a rough idea of what perhaps the more conservative investment portfolio could look like in terms of a return on investment. Again, we'll use the life strategy funds as a benchmark, so starting off with the 60-40 investment portfolio, it's actually provided a compounded annual growth rate in the past 10 years of 6.58%, and a 40-60 portfolio has provided a compounded annual growth rate of 5.48%. So you can certainly see how when you're weighting towards equities tiers down, your investment returns tier down too. But hopefully what you can see from looking at figures like this is, despite the crazy inflation figures that we've seen this year, let's park those to one side. On a normal year with normal levels of inflation, just looking at these types of investment portfolios, your real wealth will go up over time, which of course is one of the main reasons for becoming an investor in order to grow your wealth. Now, the only downside to these life strategy funds is that they're fixed in nature, which means the weightings of these funds don't move as you approach retirement. However, thankfully for you guys, Vanguard also has another product called the Target Retirement Funds, which is basically one of the most easiest to manage retirement planning portfolios. And in essence, these funds are designed in a way where they become more conservative as the target retirement date is approached, from the fund moving from higher risk investments like shares into lower risk investments like bonds. So you get that kind of flexible investment portfolio which naturally over time kind of progressively de-risks the older which you get and the closer that you get to retirement. And they start as early as retiring in 2025 right the way up to retiring in 2065. But let's say you're a little bit later on in life. How do you still accelerate your investment returns? Well, it fundamentally comes back down into the principle of tapping into the power of compounding. And the only way for you to do that is to have more money to invest, because the more money that you have at your disposal that you can put to work in the stock market, the quicker that it will grow. You know, I said at the start of the video that Buffett generated 99% of his wealth after the age of 50. Well, he actually generated over 50% of his wealth after the age of 83. So that just certainly goes to show that age is just a number. If you can make up the shortfall through additional income, perhaps the promotion at work, perhaps even surplus cash, perhaps even an annual bonus, then you'll still have a chance of reaching that goal of complete financial freedom after all. Now, whilst all of that is super important to understand, I appreciate that some people right now might be slightly concerned at the broader macroeconomic environment and the kind of thoughts and threats of a potential recession, and how that could potentially impact their investments moving forwards. So in light of that, I recommend that you check out this video next, where I actually share what Vanguard thinks that you should actually do with your investments during a recession in order to maximize the value of them. So with that being said, I'll see you over in the next one.